You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 24th of November 2025 and I'm joined by my co-host John McEwen. In this week's episode, we'll be discussing Novo Nordisk, AutoTrader, Sainsburys, M&S, BT, and our US company of the week is AMD. John, do you want to start us off with Novo Nordisk, a company we now both own?
Yes, and hopefully it's not another example of a falling knife. But anyway, it's the biggest biggest pharmaceutical in Europe, and it's most famous for Ozempic, although it does have a much broader portfolio, particularly specialising in diabetes. Anyway, operating profit increased by 5% in Danish kroner and 10% in constant exchange rates to around 95.9 billion Danish kroner. And that was impacted by one-off restructuring costs of around 9 billion kroner related to the company-wide transformation with the aim of streamlining Novo Nordisk's operation to reinvest for growth. Had Novo Nordisk not incurred such restructuring costs amounting to the 9 billion, operating profit would have increased by 15% in Danish kroner and about 21% in constant currency. Sales in US operations increased by 12% in Danish kroner and 15% at constant currency, and sales in the US were positively impacted by gross to net sales adjustments, and sales in international operations increased by 13% in Danish kroner and 16% in constant currency. Sales within diabetes and obesity care increased by 12% in Danish kroner and 15% in constant currency, mainly driven by obesity care growth of up to 37% in kroner and around 41% in constant currency, with GLP-1 diabetes sales growing by 7% in Danish kroner and 10% in constant currency. Rare disease sales increased by 10% in kroner and 13% at constant currency. Within research and development, Novo Nordisk announced that the US FDA has approved the indication of Wegovy for the treatment of MASH, which is basically liver disease. Further, Novo Nordisk agreement to acquire Akero Therapeutics and its phase 3 FGF21 analog in MASH. And also they've got another inhibited drug for a rare blood disorder. And they have another drug coming through in the weight management division. For full year 2025 outlook, sales growth is expected to be between 8 and 11% at constant currency, with operating growth expected to be between 4 and 7%, also at constant currency, including a negative full year impact of around 8 billion Danish kroner for the company-wide transformation. The narrowing of guidance ranges reflects lowered growth expectations for Novo's GLP-1 treatments within diabetes and obesity. In October, Novo announced that the board of directors decided to convene an extraordinary general meeting to be held on the 14th of November to elect new board directors of Novo, which has now happened. The other thing that's also happened since these results came out is that there were poor results in an initial trial, a trial which was essentially looking at the role of the oral semaglutide to slow the progress of Alzheimer's dementia, and basically it failed to demonstrate any benefit. And the program's been discontinued, which prompted the shares to be down around 8.5% on the day. In terms of valuation, Novo had a market cap of around £110 million and is trading at around 12.5 times forward earnings with a prospective dividend yield of 3.8%. I thought these results were all right and certainly not, I think, justifying the share price moves with it. I think Novo has become much more volatile than it ever used to be after it discovered Wegovy and Ozempic, and I suppose to a degree the success that they have had and also how that has been much more moderated and impacted by that battle that's been going on with Eli Lilly and Mounjaro. And that's it, almost as though it's just based on the future of Wegovy and Ozempic rather than the rest of the portfolio, which has a really strong diabetes division. And I think that is probably why you're seeing these massive price moves, because that's almost been disregarded with the hype around the GLP-1s. At least I hope that's the case. I think if you're buying at 12.5 times forward earnings for a company like this that has been around for as long as it has been, and again, it has the rare diseases, it also has other things in it. I mean, it goes into sort of HRT, for example, but the big stories over the last couple of years, and probably really since 2022, have been just focused on the GLP-1s. So I still like Novo. I think it's been a turbulent time, and they have had various changes in the board as well. I don't think this has necessarily helped things. However, I would take a long-term view with it. I think with that valuation that you've got pretty good, or the way I see it for myself is I've got pretty good protection there, even if the GLP-1s, it was to be subsumed by Eli Lilly going forward, which that seems a bit pessimistic, but I think there's an awful lot going for it. And with that valuation, the amount of shares that they're buying back and the dividend, it's certainly very attractive in my opinion. Sam, what do you think as a fellow shareholder?
Yeah, I think it's overblown. It's not necessarily that the company's not been doing as well as people hoped it would, because it's definitely been disappointing performance. Although I can't say I've been overly disappointed, because I think by the time we bought in, a lot of this was factored into the price. But I just think a lot of this has become a bit overblown. So forward P of under 13 for a business of this quality, putting up these kind of growth rates. Yes, I accept the growth is slower than it previously was, but for under 13 times earnings, that's a very healthy growth rate. Yes, it's losing market share to Eli Lilly, but it's still a growing market. It's still growing the business. I don't see a situation where it goes into decline. And I just think as well, like you say, when you strip out those cost-cutting measures, it's actually, for 13 times earnings, you'd struggle to find actually a healthier set of results for under 13 times earnings, I think.
No, absolutely. And probably a business of this quality under...
Exactly. But again, and obviously, you've referred to the drop today from the trial for the Alzheimer's.
Yeah.
The pipeline's probably my biggest weakness with this.
Yeah.
We've been pretty clear we don't understand it, but we think the valuation, you obviously understand it better than me, but we think the valuation is such that maybe de-risks it a bit. I mean, the article I'm looking at, analysts had referred to the trial as a long shot. Novo Nordisk itself had previously referred to it as a lottery ticket.
Yeah.
So you can't be overly surprised that it's failed.
Yeah.
Now, the Ozempic and the Wegovy, they have a lot of other potential applications. Some will hit, some will miss. I think even if they all miss, when you look at the core business and the growth rates, you could still do very well. So I just think on a valuation basis, you are getting to a scenario where it's kind of, unless the business starts shrinking, which I don't see, I struggle to see it getting much cheaper.
Yeah, and it's interesting anecdotally seeing a lot of people who are on weight loss drugs in the UK. And I think when Mounjaro came out over a year ago and there was the 1-year deal in the UK, it was relatively on, price wise, it was pretty much the same as Ozempic, and you seem to get better weight loss with it. Now what's happened is since that 1-year deal has ended, all of a sudden, Mounjaro has become much more expensive. So you are seeing a lot of pharmacists and sort of private weight loss companies switching people back to Ozempic or Wegovy, strictly speaking. And that is on a price basis, and it does work. It's just perhaps slightly less, it is slightly less effective than Wegovy, but they're still very effective and very good drugs. And also, this is not, and as you sort of pointed out, not to comment on the future pipeline. And if that is half decent, then again, it looks incredibly cheap. But the market obviously takes a different view. So maybe there are things that we are just not aware of, but hopefully it won't be as pessimistic as it's currently priced. And if they keep putting up these figures, then it looks, it will soon look incredibly cheap.
Yeah, I would agree. I'm just seeing how long it is until, because I think their oral trials were quite positive anyway.
Yeah.
Yeah, so expected to become available in a pill by the end of 2025, it said, with market availability possible in 2026 if approved. So yeah, I think once that pill comes out as well, I think that will level it a lot. Because at the minute they've got to inject it, haven't they?
Yeah, they
and
do.
And that is just less pleasant.
Yeah, no, you are right there. I think it broadens things even further if it has similar sort of efficacy to the injections. But yeah.
But yeah, I think for 13 times earnings, like there's still a lot to be optimistic about.
Yeah, no,
so fingers crossed.
Would completely agree. So let's see. It'll be very interesting as well because I think for us we covered it a couple of times, and then I think Terry Smith's sort of analysis of it when we went to Fundsmith last year, in fact it was earlier this year, was really compelling. It'll be interesting to hear what his take is next year because I think that was one of their prime holdings.
Yeah, and it's not done well.
No, it hasn't.
I think he bought it a lot higher than others as well.
Well, I think he's owned it for a long time. So I think he'll probably... the initial position will have been many, many years ago. And then he'll have added to it over the last few years. So I don't know what the average will be. And or actually, to be honest, because I don't own Fundsmith, what the the fund performance will have been. But anyway... We will see.
I only check in once a year when he does the AGM.
Like to see the man, the myth, the legend.
Absolutely. Should we move on to AutoTrader?
Yes. So I would say a favourite of the show. It's not one that either of us own.
No, it's not. But I think that's mainly due to a better similar business that we do own. Which
has taken a tumble, but I don't think we'll have to cover it next week.
So, AutoTrader, they have come out with their half-year results, and group revenue was up 5%, and that was made up of AutoTrader revenue, which was up 5% to 296 million, and Autorama revenue, which was up 13% to 21 million, so much, much smaller. Autorama, for anyone who's not familiar, that's their leasing side of the business and like car finance side of the business. And that was a fairly recent acquisition. I say recent, it was a few years ago now. In terms of operating profit, AutoTrader operating profit was up 5% to 208 million. And that's on revenue of 296. So absolutely fantastic margins. Not quite at Rightmove's level, but not far off. And the Autorama operating loss narrowed by 50% to 1.4 million. The operating profit margin remained flat for AutoTrader at 70%, and the operating profit margin for the group overall was down at 63%. However, that was up 1 percentage point due to the narrowing of the Autorama loss. Basic earnings per share, that was up 11%, 17.26p, and cash generated from operations was up 7% to 215 million. They've said retail revenue grew 6% through a 1% increase in forecourts and average revenue per retailer growth of 5%. As part of the annual pricing and product event, they launched Co-Driver, their generative AI product, which helps retailers create high-quality vehicle listings in significantly less time, while also improving the experience for car buyers. They see a rich future pipeline of AI opportunities to drive improved performance, efficiency, and time saving for their customers. Most buyers continue to come directly to AutoTrader, but for the 18% that find them through organic search, they believe AI tools will become an alternative interface and they will increase visibility across these platforms. They're continuing to scale Deal Builder to become the core consumer proposition on AutoTrader, reflecting change in approach that they outlined in the full year results. They continue to see strong levels of demand for used cars, with record number of cross-platform visits spent on AutoTrader and continued high levels of engagement. The new car market grew 3% over the 6-month period, with continued strength in volumes through the fleet channel rather than through retail. Implementation of a new government electric vehicle grant combined with an increasing number of new entrant brands is likely to support further volume growth in the second half. They've returned 162 million to shareholders, and that's up from 120 million a year ago. And that's made up of 100 million of buybacks and dividends of 62 million. In terms of market cap, that's a market cap of 5.67 billion for context. And they've declared an interim dividend of 3.8p, and that's up from 3.5p a year ago. And they've said that over 75% of all minutes spent on automotive marketplaces was spent on AutoTrader, and that's basically flat. Also, this is separate to AutoTrader, but I do think it's worth mentioning. I think this is last week or so. I just kind of saw it on Twitter, and I think AutoTrader shares actually took a dive on the announcement. But Ford have recently announced a partnership with Amazon to sell certified pre-owned Ford Blue Advantage vehicles directly through the Amazon platform. So this is just a pilot in 3 US cities at present, but if that goes well, that could be the start of Amazon really digging into AutoTrader's turf. I think as well, definitely a lot of car dealerships don't actually like using AutoTrader. So if there was an alternative platform like Amazon, I think they'd be keen to go for it. I expect Amazon would charge lower fees than AutoTrader. That being said, well, whether the dealers like it or not, they are to a large degree dictated by where the minutes are. And I think 75% of minutes on AutoTrader's platform, I don't necessarily see that changing. So it might be that it's actually quite similar to kind of when kind of On the Market got bought by that US company and Rightmove took a dive, and then so far it doesn't seem like anything's really happened. So I think it's very much watch this space. If I was an AutoTrader shareholder, I probably wouldn't be too concerned about this at present. I'd definitely be monitoring it, but it is worth noting. In terms of the valuation, the business trades at a PE of 21 and has a yield of 1.6. I think that's probably the best PE ratio we've seen it at in a number of years. And I think that's on a pretty decent set of results. John, what do you think of results, valuation, and also the Ford news? Does that change your opinion of the business?
Yeah, no, I don't think it does fundamentally. Yeah, I think I was more worried when CoStar bought On the Market than I would be about Amazon coming in. And it's also, they're just trying it with sort of used Fords for that to translate into them sort of taking market share away and undercutting AutoTrader. I think that's a long, long way off. So I wouldn't be unduly concerned. I thought it was a great set of numbers. Still, fantastic company, fantastic margins. Would I be looking to buy at the current valuation? Probably not. I think I'm more happy with Rightmove, perhaps the slightly better company, and just watching from the sidelines really when it comes to AutoTrader. But operationally and in all respects, really, I think they've done a fabulous job.
I think as well with Amazon, it's important to remember Amazon try a lot of things. Some fail, some don't. And it's a fantastic, fantastic business, but not everything they do works. And they do tend to drop projects quite quickly that don't work. As an example, I think they tried years and years ago to knock eBay off the perch. But if you want to bid for something that's secondhand or sort of vintage or, anything like that, people still go to eBay. Amazon would have loved to have knocked them off the perch, but eBay have their own little niche. I think when AutoTrader is already as dominant as it is, it's really, really difficult taking them on when they've got such a high proportion of consumer minutes.
Yeah.
Because as well, you can buy cars on Facebook Marketplace now, and that's not really made a difference to AutoTrader. So
yeah, it's the sort of cars probably that you're buying on Facebook Marketplace. It's probably not the same end that they're operating in. Maybe a little bit of overlap at the bottom, but not the same level, I don't think.
So, shall we move on to Sainsburys?
Yes, so it is the second listed supermarket because they used to be the big four with Tesco's, Asda, Morrison's, and then Sainsbury's. Asda basically went private equity after Walmart sold it off, and so did Morrison's. So it's really just Tesco's and Sainsbury's that we have now. M&S I'd probably put into a different category, wouldn't really call it, one of the big four sort of supermarkets. Anyway, they had the half-year results out with half-year retail sales, excluding fuel, rising 4.8% to £15.6 billion. All business units were in positive territory, with the fastest growth coming from grocery, up 5.3%. Underlying operating profit remained broadly flat, £504 million, ahead of group expectations, and the revenue uplift and ongoing cost-saving programme helped offset higher employment and regulatory costs. Retail free cash flow fell by £115 million to £310 million, and net debt, including lease liabilities, fell by around £100 million to £5.5 billion. Full-year retail operating profit guidance has been upgraded from around £1 billion to just over, and an interim dividend of 4.1 pence per share was announced, up 5.1%, and a special dividend of 11 pence per share, totaling £250 million, will be paid on the 19th of December, and an additional £150 million of share buybacks were announced to be completed by the end of 2027, and the shares were broadly flat in early trading. In terms of valuation, Sainsbury's has a market cap of £7.3 billion and trades at 13.6 times forward earnings with a prospective dividend yield of 5.1%. I thought these results were pretty good. They're ahead of inflation. They're still, I don't think overall it's quite as good as Tesco's, but it is a bit cheaper and the dividend is a bit higher. I think you are seeing with Sainsbury's, it's well into the turnaround and it's gone very well. I think you also are seeing, we've said it with Tesco's, that they're benefiting from Morrison's and Asda going private equity, being loaded up with debt and essentially becoming less competitive on prices. And at Sainsbury's, which you think of as perhaps a slightly more premium supermarket, having the little price match right down at the bottom, but then they've also got the finest products too. So they're like Tesco's, meeting at both ends. And also you've got the busy Christmas period coming up. So I think that will be the real test and we will see what the results are like after that. For me, I don't own either anymore. I'd probably go for Tesco's, but I think both are pretty good. And if you're an income investor, it's got a decent dividend. They're doing share buybacks and you've probably got some growth anyway ahead in terms of market share there. So I think it's a decent set of results and Sainsbury's pretty good going. Not for me, but I could see why some people might be attracted to it, particularly if they're income orientated.
I largely agree. I think that grocery up 5%. I think that's superb for a business of Sainsbury's size. Like you say, it's above inflation. It's not really a growing market, so that can only really mean one thing, and it's that Sainsbury's continues to take market share from Morrison's and Asda. I don't really see that trend changing anytime soon. So I think, if you're an income investor, I think they've been a really smart operator the last few years. I think the cost-saving program, that seems to be doing very well. So you've got a very secure dividend. I think quite a reasonable valuation. Yeah, the valuation's, I think, fairly reasonable, given that I think there is maybe a bit more of a medium-term opportunity than there's previously been, in that I think they can continue taking some market share. And at 5% yield, I think with a bit of growth prospects for the dividend, I think you could do a lot worse. It's not for me personally. I just don't think it's the kind of, I don't think it's going to generate the kind of returns I'd be looking for. But if I was at a different stage in my investing career, it is definitely a business I'd be very interested in, I think, now. And same with Tesco. I'd probably just get both.
Very good. Very good. What about M&S?
M&S is another one, actually.
Oh, okay.
I think, obviously, we've covered it for a few years now. The turnaround is happening. It has had a little bit of a wobble, as was in the news recently, and I think we have covered it since the cyber attack as well, actually, anyway. But I'm sure everyone's aware of the cyber attack. It was all over the news, and anyone who shopped at M&S will definitely have been aware of the cyber attack. They have since come out with their half-year results, and as you would expect, these results have been absolutely decimated by the cyber attack. So they're also a bit misleading, which is a separate issue, which I will complain about now. So M&S's first half sales rose by 22.1% to 8 billion. So you might be thinking on the surface, well, that's fantastic. They've really weathered the storm here. If we break that down by segment, the food sales were up 7.8%. That's pretty reasonable. While fashion, home and beauty declined by 16.4% due to the cyber attack halting online sales between late April and early June. Now, for the mathematicians amongst us, you'll be thinking, well, if one part of the business went up 8% and the other part went down 16%, how does that equate to a total revenue increase of 22%? And the answer, of course, is that it doesn't. So what M&S have started doing, and they've not really, I don't think, drawn the full attention to this that they should have. You kind of have to go into the actual breakdown by segment to find it because the numbers literally just don't add up. They have now started including Ocado retail for the first time in those results. So they've included Ocado retail. They're not in the prior year comparatives, and they've just treated that as an increase in revenue for the comparative purposes, which is just wrong. The ownership hasn't changed. It's just ridiculous. They get a cross for that. I'm very, very unhappy with that because it just should be obvious. They should say that they've done that in bold at the beginning, and you don't need to sit there with your calculator wondering what's wrong. Anyway, so that's the revenue side. In fairness, it's now slightly overshadowed by what I've said, but I think food sales up 7.8% in that half with the issues they've had, I think is actually quite good. It's been at the expense of fashion, home and beauty. I think they've probably prioritised the food with the cyber attack, I think is the impression I've got with that. Underlying pre-tax profit fell by 55.4% to 184 million, and that includes 100 million of insurance proceeds. Operational performance was negatively impacted by the cyber attack, which also resulted in increased stock management costs and higher markdowns and wastage in food. Free cash flow fell from an inflow of 15 million to an outflow of 196 million. Net debt, including lease liabilities, rose by 300 million to 2.5 billion, and M&S expects second half profits to be in line with at least last year, which would point to underlying pre-tax profits of at least 468 million. And the shares were flat on the announcement. On the Ocado side, so as mentioned, they are now being included in the results. They're still a negative for M&S, but the losses are narrowing. There is also an outstanding issue in that M&S and Ocado are disputing fees due for the payment of the business, and it's basically due to targets being missed as a result of COVID. Which way that will go, I think, is probably something only a solicitor could really advise on. In terms of the valuation, the business trades at a forward P of 13, that compares to a 10-year average of 11. The prospective yield is 1.7%, and that compares to a 10-year average of 4.2. I think this was obviously a rubbish set of results, but we knew it was going to be rubbish. I really don't like Ocado being snuck in there like that and trying to present it as 22% revenue growth, because it just isn't. Revenue hasn't grown by 22%. Like, it's just incorrect and it's misleading. I really, really dislike that. I think the cyber attack, it's not ideal, but we knew it was going to affect it. But I think this is still, and you can see it in the grocery up 7.8%, which is well above inflation, and also well above Sainsburys, who we've just complimented on doing such a good job operationally. And M&S have increased that 8% with the half that they've had with the cyber attack. So I think this is a turnaround that's still very much going on. And I just think for a forward P of 13, you could do a lot worse. And I think this cyber attack, I wouldn't really factor that into the valuation because I think it's a one-off. I think the damage from it is going to be pretty minimal. I think people will still continue to shop there. I don't think that's going to change. John, what do you think?
Yeah, I think I would largely agree with you, and I think it's reassuring to see that from the groceries. As you say, in terms of the sort of accountancy tricks there with Ocado, a little bit of a red flag for me. I think I've always seen with M&S, even with the turnaround, I just think there are sort of better businesses out there, and I don't know, I don't think I've ever really bought into the M&S brand in the sense of the sort of the fashion, etc. And maybe that's just because I've sort of followed it and I've seen it, always in the financial news, and that it feels like, I don't know, 15 years that the turnaround's been going on for. And yes, it has been doing better, but it's never gone sort of great guns. So I think just as a business, I would just be looking elsewhere. Although operationally and cyber attack aside, the turnaround does seem to, in this last couple of years, seem to have materialised more.
Should we move on to another turnaround story?
Yes, absolutely. So BT Group, which we haven't covered in quite a while. I think it's probably been a couple of years. I'd have to go back and have a look. And that's BT Group of BT Broadband, EE, and also the infrastructure, so the Openreach network. Anyway, they had their half-year results out, with the group reporting a 3% drop in half-year underlying revenue to £9.8 billion. Weakness continues in consumer and international segments, which was steadied by a flat performance in Openreach, despite the latter seeing line losses of 242,000 against 221,000 expected. Underlying cash profits, EBITDA, were flat at £4.1 billion, with cost savings and efficiency measures balancing revenue pressure. And underlying free cash flow fell sharply, down 43% to £408 million, hit by higher capital spending and less favourable cash flow timings. Net debt rose from 19.8 to £20.9 billion over the first half. Guidance was unchanged, and BT expects underlying revenue of around £20 billion and EBITDA in the £8.2 to £8.3 billion range, with free cash flow of around £1.5 billion. An interim dividend of 2.45 pence per share was declared, up 2% on last year, and the shares were broadly flat in early trading. In terms of valuation, BT Group has a market cap of £17 billion and trades at 10 times forward earnings, with a prospective dividend yield of 4.6%. I thought this set of results was disappointing. I think some of the issues are that it requires a lot of capital expenditure. The business has a lot of debt. And I think increasingly, whilst it essentially has a monopoly on Openreach, I think you are seeing that there's increased competition there, and you're having more fibre to the door by other providers that's coming in. I think that's something in the past that you had a lot less of. So I think that's definitely a concern. I think also when you do look at the mobile division, particularly, well, it's basically EE, there's quite a lot of competition there, and also quite a lot of infrastructure spending, so more capital expenditure. So I think that is certainly difficult. Where do you get the high growth from? I think that's probably the question, and largely it's been a case of cutting costs. It's not a business that I have any interest in for those reasons. I think for me, if I were looking at this sort of sector, I've got Airtel Africa in my portfolio. Yes, it's much, much more volatile, but the growth that they've been putting up, where there actually is a market for growth, it's only, for a lot of the last couple of years that we've been covering it, it's been trading at low double digits in terms of its forward price to earnings. It's actually had quite a good dividend. And for a legacy business like this, and also I think we've touched on it before, but to bring it back up again, the pension deficit with their huge old defined benefit pension scheme is a big drain on it too. So it's just not a business that I would go near. Sam, what are your thoughts on BT?
Pretty similar. As you refer to it as a turnaround, it doesn't seem like a turnaround that's made much progress since we last covered it. Pension's still an issue. Yeah, I think I would agree. I actually think last time we covered it, I think we were probably a bit more positive about Openreach. I think since then, as you've said, there seems to be more competition. Like I've used a provider where they've gone and wired it to my door kind of thing. And I think it's actually probably not as difficult as I maybe would have perceived it to be a couple of years ago. The yield's fairly decent, but they need to improve the business if they're going to maintain that. I just think for 10 times earnings, you can get a business that's got a lot less issues than BT. Like there's some fairly decent businesses on the FTSE that aren't going to blow the lights out for 10 times earnings, but you could probably get a similar yield with, I think, less risk. So yeah, I just don't know. I don't really understand where it would actually sit in anyone's portfolio, because I certainly wouldn't be buying it for growth. I wouldn't be buying it for income because I think you can do better. And I just think as a turnaround, there's not really any signs of life since we last covered it. Nothing seems to have changed. So I just don't know why you would actually hold it.
Yeah, I think it's also interesting, when you do look back at it, because now you get used to having sort of full fibre, and there are alternative providers that are increasingly offering that. I think what BT probably did quite well, and what it rode for maybe 10 years, was not having fibre to the door, but still having elements of fiber and still making the most of that legacy copper network with probably not having to invest that much. And they spun that out for almost as long as they could. And now you're really seeing, well, actually, how much longer can you continue to squeeze that without having to invest significantly in terms of the capital expenditure on the network?
Yeah, and I think now as well, some of the other providers, like the internet is just so, like the internet we've got now, it's just so rapid. Like,
Yeah.
maybe if they made that investment, they could be a little bit quicker, but you kind of, unless the file sizes increase significantly in the next few years, I don't see a scenario where the fastest internet necessarily wins. I think price becomes much more important because the current provider I've got is probably the first one I've had in kind of like 5-10 years where I thought, well, actually, I genuinely wouldn't use quicker internet.
Yeah.
Everything's just straight away.
Yeah.
And I think yours is pretty good as well.
Yeah, pretty much at that point. And then I think you get to the stage where it's like, is your laptop, is your phone, is that fast enough to notice any difference?
Yeah.
And unless you're downloading huge file sizes, which given that most people stream, and if it can handle, assuming you have like a 4K TV, if it can handle that, then you probably don't need it much faster. Maybe if you have a lot of people or a big family living in a property, and theoretically, if everyone was streaming 4K at the same time, maybe then. But I think
can afford the subscriptions.
That's right. Maybe then, but I don't think that's probably a big concern.
Yeah, so I don't think there's a huge amount to get excited about, unfortunately. But
it's I think a tricky one for BT really, and debt and all the rest of it. How are AMD doing? I think this is a debut on the show.
It is, yeah. So AMD, so if anyone who's not familiar with AMD, they are primarily engaged with making microprocessors, GPUs, and basically similar stuff like that. So pretty similar to the kind of stuff NVIDIA's doing. Main revenue sources are graphics cards for PCs and gaming, data revenue products, powering cloud computing and AI workloads, embedded and semi-custom chips used in devices like games consoles. So AMD have come out with their Q3 results, and third quarter revenue rose to 9.2 billion, and that was up 36% and above the 8.7 billion that was expected. Growth was led by a 73% rise in client and gaming segment sales to 4 billion, and that followed a 22% rise in data center revenues to 4.3 billion. Underlying operating profit was up 30% to 2.2 billion, and that was in line with expectations. Free cash flow more than tripled to 1.5 billion, and net cash, including lease liabilities, stood at 3.4 billion. The company repurchased 89 million of its own shares during the period. However, that's on a market cap of 363 billion, so it's a drop in the ocean. And they expect fourth quarter revenue to be up around 25% to 9.6 billion, and the shares were down 4.7% on the announcement of the results. A lot of the big AI chip deals that they've announced recently are more weighted towards the back end of 2026, so they're not currently flowing through into the results. They are currently assuming there won't be any revenue to China. However, in theory, there are licenses in place that could enable them to start shipping to China again. In the computer part of the business, they have been taking market share off Intel, although not that I know a huge amount about this market, but I think Intel, it seems like, is not doing particularly well at the moment. So that's not necessarily as much of an achievement as it once would have been. In terms of the valuation, the business trades at a forward P of 42.5, and that compares to a 10-year average of 37. And the prospective yield over the next 12 months is zero because it doesn't pay a dividend. However, it is now buying back shares, so you are still getting somewhat of a yield. So I think these are a fantastic set of results. It's not a business I know a huge amount about, I'm going to be honest, but really interesting company. My concern would be, firstly, that I don't know much about it, but secondly, it's still a huge business. I appreciate it's not as big as NVIDIA, which is just a ridiculous size. I think it's about less than a tenth the size of NVIDIA. But there seems to be quite a lot of overlap. It does seem to be competing with NVIDIA. And I think with NVIDIA, I think NVIDIA is putting up even higher figures, and it's kind of already market leader. it would go in the too hard pile anyway, but I'd need a very good reason to invest in AMD over Nvidia, which with my lack of understanding, I just don't have. But yeah, interesting business to cover. John, what do you think about it and the results?
Yeah, no, I think fantastic set of numbers. I think you'd have to have a very good reason, though, to choose it over NVIDIA, and I certainly don't have the expertise to do that. I mean, anecdotally, I had a gaming computer probably going back 20 years now, and it was quite interesting because at the time, I remember when you'd be looking at a graphics card and it would always be Nvidia versus AMD and like which one was better, and there was the battle, for it. AMD also did the CPUs at the time too, and they were thought to be sort of quite fancy. You've seen both companies go on and do incredibly well. However, Nvidia does seem to have, massively sort of superseded AMD, and looking at the market cap, you've got one that's 350 billion, which is by no means small. But then you've got the other, which is, what is it, is it 4 to 5 trillion now? I don't even know with Nvidia. So yeah, I wouldn't be investing directly in either, but they do seem to be on that massive growth trend in AI and producing a lot of cash too. So yeah, I think both probably fantastic businesses, but I think you'd need some expertise and some knowledge in the industry to properly and confidently invest in them, I think.
So of the 6 businesses then that we've covered this week, Novo Nordisk, AutoTrader, Sainsburys, M&S, BT and AMD, which do you like the most and which do you like the least?
It's a fairly easy one. I own Novo and I would be sticking with that as my first choice, and probably BT would be the last choice.
Without being boring, I would completely agree. I think it's always nice when the business that you own comes first because it's not always the case. But yeah, BT is a very, very easy last, actually. Just uninvestable.
Brilliant. Well, thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.